Okay, good evening, everybody, and welcome to our session on the legislation and how it can help you to pass your exams. My name is Nicole Neville, and I'm a tax tutor at Tolley, and I have met some of you before, and I am sure I will be meeting some more of you over the next few months as you prepare for your exams. A welcome also to Karen, who is my support tutor for this evening. She is going to be looking after the chat box. So if you've got any questions, any comments, any concerns as we go through this evening session, then don't be shy to put them in the chat box. You won't be disturbing me. You'll be keeping Karen busy, she'll love me for saying this, but she'll appreciate having the connection and the contact with you. At the bottom of the screen, on the bottom left, in the files to download pod, is the slides that I'm going to be using for this session. So if you want to download those slides, then now is the opportunity to do that. I will put up those slides again, this files to download pod, at the end of the session. So you will have an opportunity to download the slides then as well. Now, looking at your responses to my polls. So I asked, have you used Adobe before? And I can see the majority of you are saying yes. I think, unfortunately, due to COVID, a lot of you will have done online tuition. So Adobe is what we use at Tolley's as our way of teaching. It's fairly intuitive, but for those of you who haven't used Adobe before, or don't remember whether or not you've used Adobe before, this is what we use when we do our online teaching. We do also do face-to-face teaching when we can, but when we do online teaching, we use Adobe. And as you can see, it gives us the facility to ask you questions, just like this poll about using Adobe, and for you to respond and engage with us in that way, as well, of course, by engaging with us through the chat box. So if you haven't used Adobe before, don't worry. This is a nice way for me to show you how it works and how helpful it can be in the online environment. Now, what else did I ask you? I also asked you, have you got a set of legislation? And I'm smiling at your responses to that. So the majority of you have said you've got the legislation, but you're totally daunted by the number of volumes. And this session is ideal for you. And I'm glad you said that, because I'm hoping that by the end of this session, you will feel maybe hopefully less daunted by the number of volumes, feeling a bit more comfortable about how to use your legislation. For those of you who opted for that, yes, it's a right riveting read. Well, I'm going to show you just how riveting it really can be for those skeptics amongst you. And then for those of you who haven't yet got your legislation, I can see you plan to, and this session will help you. And you can, as I said, watch the recording of the session if necessary, so that once you do have your legislation, then you can use it alongside this webinar, which shows you how best to navigate your way through. So let's start by having a look at some of my slides. Oh, and I took all the time I thought to prepare everything for this, and my share screen doesn't seem to be doing that, but it should be in just a second. There we go. Bear with me just a sec whilst I am back with you there. Right. So, we know that the legislation has got all the rules in there. That's why there's so many of them. It's got everything you could possibly need to know for any of the tax exams that you might be doing. But the question is, the very important question is, can you find the rules in the legislation? And then, do you want to be looking up all the rules in the legislation in the exam? And the answer to that, I can tell you straight away, is no, because you just simply won't have time. But what can the legislation be really, really useful for when it comes to sitting the exams? For the 2022 exams, you should be using the 21-22 set of legislation, and that's 5 yellow volumes and 2 orange volumes, and I'll talk you through them. The exams are open book, as you hopefully are familiar with, which means you can use any resource available to you during the exam. So that means any online resource, but also any hard copy material, like your study manuals, like your memory joggers, and your legislation. And because the exam is open book, it means you can annotate your legislation, so you can scribble all over it if you want to. You can highlight the legislation, and you can use the sticky tabs that I've included a picture of to tag the legislation. And that might be quite helpful once you've found something that you think you might need to refer to in the exam, to tag it with these little sticky tags and make a little note of what it is. So in this session this evening, this is what I plan to talk you through. I want to tell you, to start with, what is in each volume of the legislation. There's lots of them. You need to know what's in each one. Once you know what's in each volume of the legislation, I'm going to help you hopefully to learn how to navigate your way around the legislation. I'm then going to give you some highlighting tips. And then I'm going to talk a little bit about the orange books and what they're all about. Then I'm going to draw your attention to some of the hidden gems that you might find in your legislation that will be particularly helpful to you. A few words then on using the index, and then we'll finish off with some of the examiner's comments on the legislation. So that's our plan for this evening. So let's go ahead and start by looking at what is in each volume of the legislation. We've got 2 different types of legislation we need to be familiar with. There's primary legislation and secondary legislation. Now, primary legislation is the law that goes through the Houses of Parliament and eventually gets royal assent. The secondary legislation doesn't require royal assent. And the secondary legislation, as I've put at the bottom of the slide here, includes things like statutory instruments, statements of practice, extra statutory concessions, and codes of practice. And the nice thing about the secondary legislation is that it uses nice, easy language. So some of the primary legislation is not as user-friendly as you'll find the secondary legislation. The language of the secondary legislation is a lot easier to follow. Now, for the main taxes that you're probably going to be looking or needing to know the rules on will be income tax, corporation tax, and capital gains tax. For those main taxes, the primary legislation is included in volumes 1A, 1B, and 1C. And the secondary legislation is all included in part 2. For the other taxes, the more fringe taxes like inheritance tax, national insurance contributions, VAT, and stamp taxes, both the primary legislation and the secondary legislation are included in the same book. For inheritance tax and NIC, that's in part 3. The VAT is in the orange book part 1, and stamp taxes is in the Orange Book Part 2. What we're going to focus most of this session on is the main taxes that you're likely to see in your exam. So that's income tax, corporation tax, and capital gains tax. So we're going to start by having a look at the primary legislation and what's in each of parts 1A, 1B, and 1C. The way the legislation, the primary legislation, has been put together is it's been done in chronological order. So 1A starts with the earliest acts, then it moves on to 1B and 1C, and at the very end of 1C, you will find the most recent Finance Act, which is Finance Act 21. Now, if you look at your legislation, let me just grab my 1A, you'll see there's grey shadings here. These, for want of a better word, grey blobs. What are they all about? Well, during the early 2000s, a consolidation process was undertaken where some of the key rules from the Finance Acts were consolidated into 8 main acts. And those grey blobs denote one of those acts. In between the grey blobs, in between those grey shading, are the bits of the Finance Act that weren't included in the consolidation process. And the reason why they weren't included in the consolidation process is because they're probably less important, and you'll probably find that you don't need to make much reference to them, if at all. It's the main acts, the bits denoted by those grey shadings, or grey blobs as I like to call them, that you're most likely to want to refer to. So let's understand what those acts are, and I've listed them out here for you. So starting in chronological order, capital gains, the rules for that are included in TCGA 1992. So TCGA stands for Taxation of Capital Gains Act, and that was consolidated quite early on in 1992. So that's near the beginning of volume 1A. And this gives the rules on capital gains for both individuals as well as for companies. Then the next main act in 1A is the Capital Allowances Act. And this was consolidated in 2001. And again, this gives the capital allowance rules for both individuals and companies. Then for income tax, we've got 3 key acts that you should be familiar with. ITPA, that stands for Income Tax, Earnings and Pensions Act. Income Tax, Earnings and Pensions Act, and that was consolidated in 2003. Then in 2005, there was the consolidation of ITOIA, that stands for Income Tax, Trading and Other Income Act, and that's near the start of volume 1B, and then creatively named Income Taxes Act 2007, ITA, is also in 1B. So those are the 3 main acts that you should be referring to for income tax. Similarly, there are 3 main acts for corporation tax. There's CTA 2009, that's Corporation Taxes Act 2009, and then you've got CTA 2010, Corporation Tax Act 2010. And in between that, near the end of volume 1B, is TIOPA 2010. TIOPA stands for Taxation International and Other Provisions Act. Now, unless you're doing the CTA Taxation of Major Companies paper, you probably won't need to refer to that. That deals with a lot of international aspects, so things like CFCs, transfer pricing. So there's our nice big picture overview, if you like, but let's now focus on income tax. An important tax There are 3 acts which include the rules on income tax. How do we know which act has which set of rules? And I'm hoping this little trick or technique will help. Let's think about the pro forma income tax computation. So this is what I've got up on the screen, pro forma income tax comp for our tax year 21-22. Let's think about the entries that go into this income tax computation. We start with employment income. Now, if we want to know how to establish the employment income for an individual, then we're going to look into ITPA 2003. The reason we know to look into ITPA is because that stands for Income Tax, Earnings and Pension Act. So anything to do with employment income is covered in ITPA. So for example, date of receipt of salary, bonus, benefits, those rules are included in ITPA. All the rules on benefits, company cars, accommodation benefit, beneficial loans, those are all included in ITPA. Termination payments, if somebody is receiving a termination payment because perhaps their role has been made redundant, the rules on how that will be taxed is all covered in ITPA. Anything to do with employment income will be dealt with in ITPA. What comes in next into our income tax comp? Well, next we've got trading income. Perhaps the individual we're dealing with is self-employed. Perhaps the individual we're dealing with owns some properties that they're renting out, so he or she has property income. Interest income and dividend income. These are all likely or possible sources of income that an individual might have. The rules on all of these are covered in ITOIA 2005. Let's remind ourselves of what ITOIA stands for. It stands for income tax, trading, so that's your trading income, and other income. The other income being property income, interest income, dividends. That's all included within ITOIA. So if you're looking, for example, at the rules on adjustments to profit for a sole trader, you're going to want to look in ITOIA. If you're looking at the basis period rules for a sole trader, you're going to want to look in ITOIA. If the individual perhaps is a partner in a partnership, then you're going to want to look in ITOIA at the partnership rules, because ITOIA deals with anything to do with trading income, as well as we've said, the other income like property income, interest and dividend income. So ITPA is everything to do with employment income. ITOIA, everything to do with every other source of income that an individual might have. And then the final act that we need to be familiar with is Income Taxes Act, ITA 2007. And that essentially deals with anything else to do with income tax that doesn't specifically relate to a source of income. So that would cover things like deductible payments. So what is, for example, qualifying interest that can be deducted to arrive at net income? ITA will also deal with the rules about tapering a personal allowance if somebody has high levels of income. So we're going to use Income Taxes Act 2007 when we want to look at the rules on anything to do with income tax that doesn't specifically relate to a source of income. And just continuing our pro forma income tax comp, ITA 2007 also looks at extending the basic rate and a higher rate band for when somebody makes a donation to charity via gift aid. Income Taxes Act also deals with the rules on tax reducers. If somebody perhaps is subscribing for shares in a venture capital trust, a VCT. So Income Taxes Act again covers anything to do with income tax which doesn't specifically relate to a source of income. So I hope you've been paying attention, because now I'm going to ask you a couple of questions. So let's remind you of the primary legislation. We're focusing here on income tax and our 3 acts, ITPA, ITOIA and ITA. And I've asked you a couple of questions at the bottom of the screen. So these are multiple choice questions. So first question is, if you want to look up the rules on share schemes, where would you look? So vote for whichever response you think is right. And you can change your mind. So if you realise that you should have picked something else, then you can unclick it or uncheck it and tick something else. The second poll asks you if you want to look up the conditions that need to be met for a property to be considered a furnished holiday let, then where would you look for that? So I'll give you a minute to think about your answer. And then I'll explain the process or the response to you. Okay, let's have a look at the first poll about share schemes. Got quite a few mixed responses to this. I'm going to talk you through my approach to this. And if you want to change your answer, please do. And that will reassure me that you've following my thought process. Now, if we're looking at share schemes, what we're essentially looking at is sometimes referred to as employment-related securities. So this is where an employer will choose to perhaps award the employee some shares in the company, or perhaps award the employee some share options. That's the right to buy shares in the company at some point in the future. So share schemes are all to do with an employer and an employee relationship. The only type of person who will be invited to become or join a share scheme is somebody who is an employee. So I can see a lot of you changing your mind on your response, and I'm delighted to see that, because we're looking here at an employer-employee relationship. And remember, we said anything to do with employment income is going to be covered in ITPA, because ITPA, remember, stands for Income Tax, Earnings, that's earnings from employment, and Pensions Act. So the rules on share schemes are indeed all included in ITPA. So well done on that. Next, let's have a look at my second poll. If you want to look up the rules on furnished holiday lets, where are we going to look for that? Well, a furnished holiday let is nothing to do with employment. You don't have to be employed to have a furnished holiday let. It is income that an individual is receiving from renting out a property that is considered to be a furnished holiday let. So this is not employment income, it is perhaps other income. And we know ITOIA stands for income tax, trading, and other income. Furnished holiday let income, property income is a good example of other income. So where we're going to look to find the rules on this is in ITOIA 2005. So well done to those of you who got that right. So hopefully you're getting the hang of this. I'm going to keep asking these sorts of questions throughout the session just to get you thinking about the different acts and hopefully getting to grips with the approach to take. So we've looked at the different acts for income tax purposes. And next we're going to move on and have a look at the different acts for corporation tax. I'm just looking at the chat box. Karen says she's having issues with sound. Anyone else experiencing problems with sound? Okay, good, good. I'm going to keep going then. It looks like we're all okay, and hopefully Karen will sort things out. I'll keep my eye on the chat box in the meantime, just in case Karen needs to log out and log in again to get the volume working. Okay, so we've looked at the main acts for income tax purposes. Let's have a look at the main acts for corporation tax. And we're going to take a similar approach to identifying what act includes what set of rules. So what we're going to do is we're going to have a look at a pro forma corporation tax comp. So here's the pro forma comp. And what have we got in there? We've got trading income to start with. Let's highlight that, which comprises of adjusted profits less capital allowances. We've got some non-trading loan relationship income. We've got some property income, and we've got some IFA, intangible fixed asset income. All of these various different sources of income and the rules associated with them are included in CTA 2009, Corporation Taxes Act 2009. So that's your go-to place if you want to look at anything to do with arriving at the total profit figure for a company. So with regard to trading income, you'll see some rules there on adjustments to profits specifically relating to companies. The rules on loan relationships are included in CTA 2009, as are the rules on intangible fixed assets. What's included then in CTA 2010 is essentially everything else that doesn't specifically relate to an item of income that might be taxed on a company. So this would be, for example, loss reliefs available to a company if perhaps they have a trading loss. The rules on groups of companies are included in CTA 2010. The rules on purchase of own shares and how that is treated is included in CTA 2010. So CTA 2009 is everything that's relevant to establishing the total profit figure for a company. CTA 2010 is everything else. And then, of course, there's TIOPA, which, as we said, is very specialist and deals with international aspects. So, shall we have a go at a couple of questions on this? So we're looking now at our primary legislation for corporation tax. And my first question is, if you want to look up the rules on R&D reliefs, research and development reliefs that are available to companies, where are you going to look? And then my second question is, if you want to look up the tax implications of close companies, where would you look? So have a think about those and vote when you're ready. my first poll was quite a tricky one, particularly if you don't know much about R&D reliefs for companies. So let me give you a bit of a steer here if you need it. If a company is incurring some qualifying expenses for R&D purposes, then they will be entitled to take an extra deduction for those expenses when they're establishing their trading profits. So if R&D reliefs are available to a company, that will impact on the trading profit figure for the company. So bearing that in mind, you might want to think about changing your answer. So, and I'm seeing a lot of you changing your answer and you're doing it correctly, so well done. If an R&D relief is available, that's going to have an impact on the trading profit figure for the company, because the company is entitled to get a bigger deduction when arriving at that figure. And if, as we said earlier, we're looking at something that's going to impact on an item of income that's going into our corporation tax comp, then the rules will be included in CTA 2009. So really well done on that. As I said, that was a fiddly one. My second poll asks you to think about where to look for the tax implications of close companies. So here we're not looking at a specific type of income that's going to go into the corporation tax computation. We're looking at something else. So if we're looking at a set of rules that won't impact directly on a source of income for the company that will help us arrive at the total profit figure, then we need to look into CTA 2010. And very well done. Good, so we're really getting the hang of this. So that's excellent, well done. So my advice to you, now you've got a feel for what's in each volume of the legislation, is when you are studying, when you are looking at the study manuals or you're coming on any of our courses, you'll see we give lots and lots of legislation references. My suggestion to you is study with the legislation. Have it alongside you and look things up where you think it's going to be helpful. So think about what you're going to need for the particular exam that you're sitting and for the particular syllabus relevant to your exam. And you're not going to be able to look everything up in the exam. You won't have the time and you shouldn't hopefully need to. So what you should perhaps consider highlighting are the things that you don't want to have to commit to memory. So things like definitions, rules, conditions, amounts, time limits, the sorts of things that you can highlight carefully and save clogging up your memory with that information. Now I want to talk you through the best way to navigate your way around the legislation. And my advice to you here is to start by highlighting the contents pages. So let me talk you through what I mean on that. And let me do that by reference to exempt benefits. So I said I'm going to ask you the same style of question a few times, so here I am again, so asking you, if you want to look up the details on exempt benefits, oh, sorry, I didn't mean to do that. Let's just get that back. If you want to look up the details on exempt benefits, benefits that might be provided by an employer to an employee which are not taxable, and you want to have a look at what those are, where would you look? So I've given you a list at the top of the screen of the different acts that we're familiar with, just to help you out. And your answers are looking excellent. Well done. I'm nodding away because I can see your responses. I will broadcast the results in just a minute, but I'm nodding away because I can see that the responses are really good. So what your thought process, I hope, is an exempt benefit. Well, we're looking here again at the employer-employee relationship. So the employer is providing some sort of benefit to an employee, and we think, or we want to identify whether or not that benefit is taxable or exempt. Because this is something to do with employment income, we're going to look in ITPA 2003. So, yep, very well done on that. Okay, so let's have a look at an extract of the contents page for ITPA. So this is just a very small extract on miscellaneous exemptions. Now, this is coming from the contents page. And what I want to show you here is just sometimes by just highlighting and referring to the contents page, that might be all you need. You might not even need to go into the actual statutes, the actual legislation detail to find the answer that you're looking for. So, for example, you might see an employee in a question whose child goes to the creche that is on site at the employer's premises. And you'll see from section 318 that employer-provided childcare is an exempt benefit. Or the employee in question might be provided with a mobile phone. And you'll see, just from highlighting the contents page, that mobile phones is an exempt benefit. Maybe our employee is being awarded an award for long service, and you want to identify whether or not that is an exempt benefit. Let's have a look at my question at the bottom of the screen there. Now, this question is a multiple response question. The way you can see that is rather than circles next to each option, there are squares next to each option. And I'm asking you there, what conditions must be met for a long service award to be an exempt benefit? And you can tick any or all of the options, the three options that I've given you. So I've said option 1 cannot be more than £50 per year of service. Option 2, the employee must have had at least 20 years of service to be considered long service. And option 3, don't know. Don't know how much can be awarded per year of service. Don't know how long the employee must have been employed for. But what I do know is I can look it up in section 323 of ITPA. So vote when you're ready, and remember, you can choose more than one option. And I'm going to tell you that all three of those options are correct. So just starting with the bottom one first. If you didn't know, I am sure that you are, well, I can see you're certainly not alone, because quite a lot of you didn't know. And it doesn't matter, because you know where to find the rules. And if you do look in section 323, so having highlighted it in the contents page, you now know the rules are in section 323, and you will see there that for a long service award to be treated as an exempt benefit, the conditions are, number 1, it cannot be more than £50 per year of service. And number 2, the employee must have had at least 20 years of service. And if both those conditions are met, then any award that is made to such an employee will be an exempt benefit. So highlighting the contents page on its own might be good enough. But even if it's not good enough, then you know where to look for the details. So if you don't remember them and there's no need to, you know you can dip into section section 323 and find the answer. Let's have another go at this. Let's think about something totally different now. Options available to a sole trader for relieving a trading loss. So we've got a self-employed individual. He's got a trading loss. He wants to know what options are available. How can he get relief for that trading loss? So please start by telling me which act do you think is going to be the one to refer to help you on this. Okay, let me help you out a little bit here if you're struggling. We're looking here at a sole trader. A sole trader is just sort of tax terminology, if you like, for a self-employed individual. So we're not looking at an employee here. So the answer to this won't be found in ITPA because we're not looking at an employee. We're looking at a self-employed individual. So next we need to think about the options for relieving his loss. Is that relating to trading? Well, it relates to trading income, but does it specifically help us to establish what the trading income figure is, or indeed any other income? I don't think that's the case. What we're looking at here is once we've established that this individual's got a loss, what can he do with it to get relief? So what we're looking at here is something that doesn't relate to either employment income or indeed to the calculation or establishment of any other type of income. So it will be covered by the catch-all, by Income Taxes Act 2007, which catches everything else to do with income tax that doesn't specifically relate to a source of income. So I can see a number of you changing your responses there. Good, delighted to see that. So the different options available to a sole trader for relieving his trading loss will be covered in ITA 2007. So let's go into the contents page of Income Taxes Act 2007 and see how that can help us. So here is an extract again of the contents page of Income Taxes Act 2007. And this might be a really helpful way for us to think about structuring an answer if we do see perhaps a question in ATT paper 2 or paper 4, or indeed in CTA in the OMB advanced technical paper, where we have to advise a self-employed individual on how best to relieve their trading loss. So what I'm going to do as I talk you through this is have a little question up on the left-hand side of the screen. Let's not worry about that question quite yet. Let's just have a look at how the contents page of Income Taxes Act can help us. So it starts by giving us the rules in section 64. Section 64 allows the trader to take a deduction from general income for their loss. And that's a deduction that is available in the current year and or the previous year. So the detail won't be included in the contents page, but it will give you perhaps a little steer in the right direction. Then there is section 71, and that is the extension to 64, which is all about setting off the trading loss against capital gains. Then you've got early trade losses relief. And Section 72 looks at relief for individuals for losses in their first 4 years of trade. So this is special relief that's only available to somebody who's just started to trade and made a loss in any one of their first 4 years of trading. And this allows them to carry back their loss for 3 years against total income. Then we've got the carry forward option, and that's covered in Section 83. And this means that the loss is going to be carried forward against future trading profits indefinitely until that loss is fully relieved. Then Section 86 is a very specific type of loss relief, which is available to a sole trader who is incorporating his business. So he's transferring from being a sole trader to being a limited company. If he's got a loss just before incorporation, then Section 86 relief would be available to him. And then finally, we've got terminal loss relief, which is talked about in Section 89. And that's where our sole trader has a loss in the last 12 months of trading. And terminal loss relief allows the sole trader to carry back that loss 3 years against trading profits. So let's now have a look at my poll on the left-hand side of the screen. If you're dealing with a question in the exam about a sole trader and he's just started trading, so just started his sole trade business, and he's made a loss, which loss relief options would be relevant or available to him? So using what we've just looked at, highlighted from the contents page, can we make a stab at which loss relief options we think we would want to talk about as being available to this trader? So again, this is a multiple response question. Vote when you're ready. And answers are looking really good. So when we're looking at an individual who has just started trading and has made a loss perhaps in their first or second tax year of trading, let's think about what options are available to this trader for relieving their loss. Let's work from the bottom up. Section 89 is all about loss reliefs available to somebody who is ceasing to trade. Well, that's not going to be relevant to our individual because they're starting to trade. So I'm glad to see very few of you selected Section 89 because that's not going to be relevant. And similarly for Section 86, because that's all about loss relief options available where our sole trader is incorporating his sole trade business into a limited company. Again, that's not the case here. We're just looking at somebody who's just started trading and they've got some losses. What will be available to them, though, is the Section 83, the carry forward. So hopefully in future tax years, they will be making trading profits and they can then carry forward the loss against those. Section 72 relief is quite often the preferred option because this allows the individual to carry back the loss 3 years. And this is only available to somebody who is making losses in their first 4 years of trading. So ideal for our situation here. By carrying back the loss, that means that the trader will get a repayment of tax in those previous years. Section 64 is always available for our trader to set the loss against their general income of the current year and or prior year, as is Section 71 if the individual has made capital gains in either the current year and or prior year, then this relief will also be available. So looking at your answers, it's the first, how many are there? 1, 2, 3, 4, 4 options that are correct and relevant to write about. It's the last 2 that would not be relevant. And looking at your responses, it seems like you've understood that really well. And that's just from looking at the contents page of the legislation. We haven't even gone into the detail that's inside that section. So very well done on that. So we've looked at the contents pages in quite some detail. Let's now have a look at situations where we might need to go into the actual statutes, into the actual sections, and highlight some of the conditions. So the first thing we're going to look at as an example here is EIS Relief. EIS, remember, stands for Enterprise Investment Scheme. So we might have somebody who is considering subscribing for shares in an EIS company. And you might be asked to advise about this in the exam. This is the sort of thing that comes up quite frequently in ATT paper 1. It comes up quite frequently in CTA in the Advanced Technical Individuals paper. And you might know that there are lots of conditions that need to be met for this relief to be available. The individual subscribing for the shares must be a qualifying investor. The shares must be qualifying shares themselves, and the company must meet various conditions to be considered an EIS company. So I bet you can guess my next question. Here it is. If I want to look up the conditions for EIS relief for both perhaps the company as well as the investor, which act am I going to look at? So think carefully about the approach to take and vote on that when you're ready. So this is a bit of a tough question if you're not familiar with the tax rules on EIS, but where an individual subscribes for shares in an EIS company, then they will be entitled, if they're a qualifying investor and the company is a qualifying company, they will be entitled to claim an income tax reducer in respect of that subscription. What that means is they will be able to reduce their tax liability for that tax year. So we're looking here at income tax, nothing to do with an employer-employee relationship. So we're not going to look in ITPA. We're not looking here at trading income or indeed any other income. So we're not going to be looking at ITOIA either. But we are looking at something relevant to income tax, but not specifically related to either employment income, trading income, or any other income. So where we're going to want to look in this case, as I can see the majority of you are agreeing, is Income Taxes Act 2007. Because remember, that deals with anything to do with income tax, which doesn't specifically relate to employment income or any other type of income. So we're going to look into Income Taxes Act 2007. And up on the screen here, I've got an extract from the contents page. And we're going to focus specifically on the conditions that need to be met by the company for it to be considered an EIS company. So what types of company will be considered EIS companies? And as I go through some of the rules on this with you, there's a little question on the left-hand side for you to be pondering over. We'll look at it together in a few minutes. So, Chapter 4 of Income Taxes Act 2007, Part 5, deals with the conditions that the company needs to meet for it to be considered an EIS company. So let's go into that bit of the contents page. So I'm now in Chapter 4, which is all about the issuing company. And the contents page themselves can be really helpful because it's telling us, firstly, that the company must have a permanent establishment in the UK. It's telling us that the company must be a trading company. Then it's also telling us that not only must the company be a trading company, but it also has to have a qualifying business activity. We're told also that the company must not be quoted. And we're told it's got to be of a certain size. So it's got to have a certain level of gross assets and a certain level as to the number of employees in the company. So we don't get all the detail here, but we get some idea of some of the conditions. Let's focus specifically at the type of activity, the type of trade that this company must have to be a qualifying EIS company. So let's dig a little deeper. Let's start by having a look at section 183. What do we mean by a qualifying business activity? So let's have a look at what section 183 says. And here is an extract of section 183, and I won't go through all of it with you, but what I will show you is it says that a qualifying business activity means that the company must have a relevant qualifying trade. That's not really telling us very much. So let's keep going. Let's have a look at section 189. That gives us the meaning of a qualifying trade. What does section 189 tell us? It tells us that it must not be carrying on any excluded activities. But we still don't really know what is a qualifying trade because we don't know what these excluded activities are. So this is why it's so important to not just rely on your legislation in the exam without having looked up some of these rules beforehand and carefully highlighted them so you know where to find them. Because if you do then go on a bit further and look in section 192, you've got there the meaning of excluded activities. And here you've got your definitive list of what is an excluded activity or an excluded trade for an EIS company. So if this company that we're considering carries on a trade which is in this list here, then it can't get EIS status because this is an excluded activity. Now, let me highlight a few of them for you. So if our company has got a trade which is something to do with banking, insurance, then it can't get EIS status. If it's carrying on a trade that is heavily asset-backed, like property development, farming, market gardening, or hotel management, then again, it can't qualify for EIS status because it is carrying on a trade that is excluded. So now let's have a look at my poll on the left-hand side of the screen. This is a situation you might face in the exam. You're told your client has just set up a company which owns and manages boutique hotels. He wants to know whether his friend can claim EIS relief if he subscribes for shares in this company. Now, you might want to focus for a minute on what this company does. It manages boutique hotels. And having that at the forefront of your mind, vote when you're ready at whether or not you think EIS relief will be available. And you might want to look into what's up on the screen in section 192 in part J that I've highlighted for you. And I can see a lot of you have done that. Let's put a box around it. Section 192 part J. There you go. The answer there, and I'm delighted to see you getting that, is EIS relief will not be available because hotel management is not a qualifying trade. So well spotted. And this is the sort of thing, you couldn't possibly commit all of these excluded activities to memory, and you wouldn't need to, because now you know where to find it. You can take a little sticky tab, you can label it up, excluded activities for EIS, and now you know where to find it in the legislation. And this is your definitive list. So if the trade of the company isn't on this list, then it won't be an excluded activity. So very well done on that. Whilst we're talking about EIS companies, let me just give you a little bit more detail on the gross assets requirement. That's in section 186. The gross assets of the company must not exceed £15 million before the share issue and must not exceed £16 million immediately afterwards. And notice the way I've highlighted it there, really carefully, just the key words, 15 million before, 16 million after. So again, I don't need to commit the rule to memory, but I do have it highlighted and ready for me to refer to if I need it in the exam. A little bit more on highlighting next. Highlighting as a signpost. So perhaps thinking about using different coloured highlighter pens to help you out. So we're going to look here at capital allowances. Now, capital allowances for both individuals and companies are covered in Capital Allowances Act 2001. And we might need to identify whether various different items that have been acquired by an individual for his trade or by a company for their trade will qualify for capital allowances, will be treated as plant and machinery for capital allowances purposes. So at the very beginning of the Capital Allowances Act, we've got section 21 and section 22, which tell us what's a building and therefore not considered plant, and what is a structure and therefore not considered plant. So anything that's listed in section 21 or section 22 will not qualify for capital allowances. But then immediately following that, we've got section 23. And section 23 gives us a list of items that look like they might be part of the building or part of the structure, but nonetheless are considered to be plant, and therefore capital allowances will be available. So what I'm thinking here is that with clever colours scheme, I can highlight perhaps everything in, as I've done here, or underlined everything in red, which won't qualify for capital allowances. So red meaning stop. And everything that does qualify for capital allowances, so the things that are in section 23, I'll highlight in green because capital allowances are available. So here's my little question on the left-hand side of the screen. We'll think about that question. Now we're looking at some of the detail in sections 21, and we'll have a look in section 23 as well. So here I've, if you like, pre-highlighted this for you. So section 21 tells us that anything that is a building or part of a building will not be considered plant and therefore will not qualify for capital allowances. So I'm highlighting all of this, as you can see, in red. And list A is particularly helpful because list A gives us a list of assets that are treated as being part of a building. So what's in list A? Let's just look at a few items. Walls. Those are treated as part of a building and therefore will not qualify for capital allowances. Similarly, floors, ceilings, doors, gates, shutters, windows, and stairs. These are all part of the building, so won't qualify for capital allowances. Let's pick out something else. Let's have a look at number 5 here. Shafts or other structures in which lifts, hoists, escalators, and moving walkways are installed. So all of these are assets which are treated as being part of a building and therefore capital allowances are not available. So you might want to take a quick look at my poll below the webcam and think about your answer or start answering. So what we've got here in the poll is your client in an exam question, perhaps in paper 2 or paper 4 for ATT or OMB for CTA. He's just bought some office space and wants to know whether the following items qualify for capital allowances. This is a multiple response question, so you need to tick which items qualify. So remember, anything that is a building or part of a building, as we've just highlighted, will not qualify for capital allowances. Okay, there's a bit more because what I'm going to do is now take you to section 23. Section 23, I've already highlighted in green for you because this is the good news. These are the things that might look like they're part of the building and therefore you'd have thought will not qualify for capital allowances, but actually they do. So thermal insulation, for example, is covered in section 28. That does qualify for capital allowances. It is treated as plant and machinery. Section 33A looks at integral features. Those are integral to the building, but will still qualify for capital allowances, still treated as plant and machinery. So by all means, do look into section 33A, and that will tell you that an integral feature would be an air conditioning unit, would be escalators, moving walkways, and lifts. They might be integral to the building, and you'd have thought, therefore, won't qualify as plant and machinery. No capital allowances are going to be available. But because they're listed in section 33A, we've highlighted them in green. The good news is, yep, capital allowances will be available. And then there's a really useful list, list C, in section 23, which lists out some items that, again, you'd have thought might not qualify for capital allowances, but actually do. And let me just draw your attention to items 13 and 14 at the bottom of the list there. There you've got partition walls. Now, walls, you would have thought, that's part of the building. I'm sure we highlighted that in red when we looked at that in section 21. But if those walls are movable and are intended to be moved in the course of the qualifying activity, then they will be treated as plant and machinery and capital allowances will be available. So think about your office space, if you have been into your office at any time recently. Sometimes you get those partition walls that do get moved around, and perhaps as you have little restructures and reshuffles, those partition walls are moved around in different ways, those will be eligible for capital allowances. But if the wall is fixed in place and is not movable, then it's part of the building and won't qualify. Let's have a look at item number 14 on this list. Decorative assets. So a decorative asset might be some sort of painting or mural that's hanging on the wall. That will be treated as eligible for capital allowances, provided it is for the enjoyment of the public in a hotel or restaurant or similar trade. So there, what we're looking at is something that performs a function in the trade. It's helping to create the right sort of atmosphere. So a picture, a mural that's in a hotel or a restaurant, perhaps designed to relax the customers and make them enjoy their meal or enjoy their hotel stay, that will qualify for capital allowances. So you can see these rules aren't quite as simple as they might have seemed at first. Let's have a look at my question. My question was a very tricky one. Will partition walls qualify for capital allowances? Well, the answer really is it depends. If they're fixed in place, no, they won't. If they're movable and intended to be moved in the course of the qualifying activity, as we've listed here in item 13, then they will qualify for capital allowances. So if you tick that, yeah, you could be right. If you didn't tick it, you could also be right. And this sort of starts to give you a bit of a sense for the types of questions you could see in the tax exam. Sometimes there's not a yes or no answer. You need a little bit more information to be sure. Shafts to install an escalator, though I think we can be quite sure of that. Here, if you recall, when we were looking at list A in section 21, item number 5 does clearly state that shafts in which the escalator is installed, that will not qualify for capital allowances because that is treated as part of the building. So we don't want to have ticked that one. The escalator itself, though, is included in section 33A as an integral feature. So well done if you tick that, because yes, capital allowances will be available for that. Stairs, though, going back to section 21, will not qualify for capital allowances because stairs are included in list A part 1. And then finally, the painting to hang in the reception area. Well, when we looked at section 23, we said decorative assets will be treated as plant and machinery and will be eligible for capital allowances, but only if they're provided for the enjoyment of the public in hotel, restaurant, or similar trade. Now look at my question. My question starts off with, your client has just bought some office space. So this painting is to hang in the reception area of an office, not of a hotel, not of a restaurant. So though it is a decorative asset provided for the enjoyment of the public, because it's not in a hotel or in a restaurant, but just in an office, it won't be treated as plant and machinery because it's not covered by item number 14 that we've just seen in section 23. I told you this was a tricky question. This really is a question of CTA standard here. So, yep, I've kept you on your toes with this. So, which items will qualify? Partition walls will qualify if they're movable and are indeed moved. The shaft to install the escalator won't qualify, but the escalator will. The stairs won't qualify, and neither will the painting to hang in the reception area because this is an office space, not a hotel or restaurant. So that was a tricky question. So if it kept you thinking, That's what this is all about. And your legislation, as you can see, can be tremendously helpful if you have a question similar to this. Okay, so we've looked at highlighting the conditions. Sorry, we've looked at highlighting the contents page, and then we went into highlighting some of the key conditions. And just now we've looked at clever highlighting using different colors. Red for the bad news, doesn't qualify for capital allowances. Green for the good news, yes, it does. I did promise we would mention the orange book, so let's do that. I would imagine that anyone who is looking up anything for VAT, whether it's the CTA awareness module, whether you're doing the VAT paper at ATT, or you need a little bit of VAT for papers 2, 3, or 4 at ATT, or for some of the OMB aspects, you'll need to dip into the orange book. Now, volume 1 covers everything you need to know about VAT. Remember, you've got the primary legislation and the secondary legislation all in the same book. So just to draw your attention to some very useful information in the primary legislation, you've got about 100 sections to the VAT Act. It's not that long, but then behind those sections, you've got some really useful schedules. Schedule 7A looks at reduced rate supplies. So which supplies suffer VAT at the lower or the reduced rate. Schedule 8 looks at zero rated supplies, and Schedule 9 gives you a list of exempt supplies. So what you've got in those schedules is your definitive list of reduced rated supplies, zero rated supplies, and exempt supplies. If the item you're looking for is in none of those schedules, then it must be a standard rated supply. There is no definitive list of standard rated supplies. You take an approach where you kind of work it out by saying, well, if it's not in one of the other schedules, then it must be standard rated. So those schedules are enormously helpful. Then in the secondary legislation, there's a really useful statutory instrument. That's what SI stands for. Statutory Instrument 1995-2518. Now that's a very long statutory instrument, so I recommend highlighting the contents page there. And among other things, in regulations 49 to 60, you've got the various different accounting schemes that are helpful to small businesses. So the annual accounting scheme, the flat rate scheme, the cash accounting scheme. And that talks about the conditions that a trader needs to meet to be eligible to join the scheme, when they have to leave the scheme, and of course how the scheme works. Partial exemption rules are in regulations 99 to 109. And then following on very close from that is the capital goods scheme rules in regulations 112 to 116. So statutory instrument there is enormously helpful, and being part of the secondary legislation, as I mentioned earlier, the language in which the secondary legislation is written in is a lot easier to follow. As well, I just want to draw your attention to a useful notice, section 4.1a, that's nearer the back of the book, which looks at international services and where the place of supply is for those services. And that can be particularly helpful if that's relevant to the syllabus that you're studying for. So going back to our direct taxes, but now thinking about part 2 of the legislation, which remember is the secondary legislation for income tax, corporation tax, and capital gains tax. What are the hidden gems? I'm just going to draw your attention to a few of them. There's a useful statement of practice, which deals with partnership capital gains tax. Another useful statement of practice, May 96, which looks at PAYE settlement agreements. So this is perhaps where an employer provides a benefit to an employee, perhaps a store voucher to the employee because they've worked so hard over the year. And the employer has agreed to pay the income tax on that benefit on behalf of the employee. This statement of practice gives you not only some examples of the types of benefits which could be the subject of a PAYE settlement agreement, but also how the income tax is calculated that the employer is going to agree to pay on behalf of the employee, and also gives some guidance about the Class 1B NIC that the employer will pay. What else? Let me draw your attention to the codes of practice on penalties. That gives you some very helpful definitions on the types of errors that an individual might make on their tax return: careless errors, deliberate errors, concealed errors, and the types of disclosure that the individual might make, which will help reduce the penalty that they pay. For anyone who's doing anything to do with overseas aspects of income tax and or capital gains tax, so paper 1 for ATT, individuals for CTA, RDR 1, 3 and 4 are enormously helpful. RDR stands for residence, domicile and remittance. And those RDRs, in particular RDR 3, gives you the statutory residency tests and all the rules about splitting tax years. And that's just lots and lots of different rules and definitions, and will just be so enormously helpful if and when you see a question on that. So just a few of the hidden gems that are included in part 2, the secondary legislation for income tax, corporation tax and capital gains tax. So we're coming to the end of the session. Let me just talk you through the index and how useful or otherwise that might be. Before I get to my poll on that, let me just tell you that there are 2 parts to the index. There's the normal index, as you'd expect. There's also the words and phrases index, which helps you identify commonly used expressions. Now, when we're looking at the primary legislation, you're going to find the index at the back of 1C, because remember, the primary legislation for the main taxes is in 1A, 1B and 1C. So if you look at the back of 1C, you've got the index for all of that. For all the more fringe taxes, you've got an index at the back of each of those volumes. And what I've said here is the index is not overly useful, and things might not be listed in the way you might expect. So, let's get to my poll first. Here's my question for you. Coming up, here we go. If I want to look up the rules on personal service companies, so this is where perhaps we're dealing with an individual who is providing a service to a company, but he's doing it through his own company. And I want to know how he's going to be taxed on any income that is paid to his personal company. Where would I look in the index? Now, I'm not expecting you to know the answer here. I'm just expecting you to sort of think, well, what would you do? So you want to look up some rules on personal service companies. What are you going to look for in the index? And unsurprisingly, we're getting a mixture of answers here. I thought more of you would go for personal service company, but not that many of you opted for that. A lot of you opted for IR35. Yep, that seems quite sensible. Or deemed employment income. Yep, you might have gone for that. No one's gone for relevant engagement. And a small minority of you have gone for intermediary. And now, by all means, do try and do this exercise yourself if you like, because what you will find is when you look this up, or if you want to try and look this up in the legislation, I can see some of you changing your mind here, you'll be surprised. Because if you look for personal service company, it won't be there. If you look for IR35, it won't be there. If you look for deemed employment income, you're not going to find that in the index either. Neither will you find relevant engagement. So for those of you who plumped for intermediary, spot on. Yep, that's where you're going to find the rules on, or where you're going to find a steer for the rules on personal service companies. It's in the index as intermediary. Yeah, so very well done if you got that one right. I don't think that would have been my first choice of words to look up. So the index can be helpful. Sometimes you'll find what you're looking for immediately, but other times less so. So don't be overly reliant on it. So where are we at? The golden rules of highlighting by way of summary here. Less is better than more. You don't want to open up your legislation and rather than having black type on a white background, you're seeing black type on a yellow background because you've got highlighter happy. So just highlighting key words, key phrases, key numbers is more helpful. As we've discussed, think about highlighting the contents page first before you then go on and highlight some of the conditions within the various sections. Using different colours, as we did when we were looking at the Capital Allowances Act, can be particularly helpful. But also remember, you cannot and you don't want to be highlighting everything. Your preparation for the exams is not going to be most productively spent doing lots and lots of highlighting. Doing some careful highlighting is valuable, but of course doing lots of question practice is also extremely important. So going back to my plan, I think we have now done justice to the plan. We started off by looking at what was in each volume of the legislation, and I've given you throughout this session lots of different polls on applying those rules. We then looked at how best to navigate our way around the legislation by starting off with the contents page, highlighting that first, and then some highlighting tips about then going into highlighting some of the detail and using different colours. We've talked a little bit about the VAT legislation, the Orange Book, and I've given you some hidden gems from the secondary legislation. We've said to be careful about using the index because it's not always as obvious as you would expect it to be. So let me just finish off by drawing your attention to the examiner's comments on the CTA advanced technical papers. So let me just draw your attention to what I've highlighted here in red. Candidates will never be penalised for referring to the legislation. And looking at the bottom, what I'm putting here in my box is there may well be some questions in the CTA exams where the examiners specifically ask for an answer by reference to legislation or case law. And in such cases, candidates who do not provide such references will miss out on some marks. So the legislation is not always, or should not be considered, an optional extra. It can, as the examiners have said, be quite fundamental to picking up marks in an exam question. And I'm hoping that this webinar has, to a certain extent, made you feel a little bit more enthusiastic, shall we say, to or less daunted, shall we say, about picking up your legislation and getting stuck into it and getting familiar with what's in it and how helpful and useful it can be. So my final comment here, though, is it's not just about the rules that are in the legislation. It's about understanding those rules and using those rules to apply to the situation that you're presented in the question, a bit like some of those polls that I asked you. The legislation won't give you the answer. That's where you need to use your brains, what we've taught you, to help you to answer and advise in the real exam. So, thank you very much for listening. Thank you also very much for participating. The session only works as well as your interaction and engagement with it. And seeing your answers to the polls and seeing how you learnt something as you went through is really helpful. I've put up on the screen there for you my email address. So if after having gone through the webinar and perhaps rewatched some parts of it, because it has been recorded and will be uploaded onto the Tolley Academy, if you've got any queries, then by all means get in touch with me. If you want to book on any courses at Tolley, then please get in touch with our exam training team, and I put their email address up on the screen as well. Beneath the webcam is a files to download pod, and in there I've included or I've uploaded for you the slides that I went through just now to present my webinar. So if you want to download those, you now have the opportunity to do that. I've put a poll at the bottom of the screen asking you how you feel about using your legislation now. Be interesting to see your response, and do feel free to be honest. And I'm smiling as I'm reading your answers there. Yep, some of you are still a bit daunted, but you're prepared to give it a go. And that's great. And I think once you get stuck in, you'll find it is more manageable. And particularly remember, in our study material, you do have lots of references to the legislation there, which should help you. It's good to see that a lot of you feel much more confident than you did before you watched the presentation. That's reassuring. So slightly disappointed that no one is telling me they can't wait to get stuck in. I was convinced that you'd all be voting for that option. That's the end of the session. I am going to say a big thank you to Karen, who you've kept very busy throughout the last hour and a half with your questions in the chat box. She's been a fabulous support tutor, as always. So thank you very much, Karen, for helping out with answering those questions. Thank you all very much for joining, for participating and engaging with us. And very, very best of luck for your studies. So do feel free to leave the session now. I will stick around for a little bit longer in case any of you have got any more questions. By all means, just pop them into the chat box and I'll happily answer them. But I am going to end the recording now.